Okay, so it looks like we are now live on our various social media channels, kicking off just a few minutes early. So I'll start with a bit of housekeeping. If you're following along on any of our social media channels, you can post your comments below. And we do have a colleague who is monitoring those, who will relay those questions over to us live in the Zoom session. If you want to join us live as part of the Zoom session, you can register for these webinars on our website, cpa4it.ca, and just going under the events section. We do host webinars every 2 weeks, and where we do our best to educate our clients and strategies to help them organize their finances, create wealth, and transform wealth into a legacy. Of course, if you are here live on the Zoom session, you can use the Q&A. Those questions will be answered first and foremost. If we get a chance, we will go back and go through the chat at the end of the session and see if there's any questions that we have missed. Without further ado, my name is Andrew Wall. I'm the managing partner here at CPA4IT, where our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We've been in business since 1984, second generation accounting firm, and we've been through a lot of these same issues and questions that you might be struggling with when you're trying to decide, when you've got money left over at the end of the day, where do you save it? Where do you invest it? Do you invest it inside of your corporation? Do you use one of these registered tools like an RRSP, a TFSA, or any of the other tools that are available to you? So today's session is designed to go through the various tools, talk about the different strategies, and help you make an informed decision on where the best place to invest your money is so that you can create that wealth and create that lasting legacy for your family. So the big fundamental question is do I invest inside my corporation or do I use one of these registered retirement vehicles? And what I would say is a good strategy is actually going to encompass a multitude of tools where you will leverage both corporate investing as well as registered retirement savings. Now, for an owner manager, the RRSP tool, which is the most well-known and well-used tool, is not nearly as beneficial as it is for full-time employees. As a full-time employee, really the only strategy that you have to reduce your taxable income is to make a contribution to an RRSP. And we'll talk through the pros and cons of the RRSP. But as an incorporated entity, you have many more tools available to you that a full-time employee does not. And that's why investing inside your corporation can have a lot of strategic advantages for you. So investing inside of a corporation, unfortunately, the downside to that is your investment income is not eligible for the small business tax rate that your normal consulting income is eligible for. So many of you are aware that here in Ontario, if you have a small business under $500,000 of net income, that's taxed at only 12.2%, whereas your marginal tax rates, your marginal personal tax rates can go as high as 54%. Now, unfortunately, passive or investment income is not eligible for that same rate, and it's taxed at the general rate, which technically the general rate is 38%, but there are some abatements and some things that bring that tax rate closer to about 28% when, for most situations. But investing inside your corporation, that investment income is going to be taxable. And the type of investment income that you have will dictate the amount of taxes that you pay. Because dividend income is going to be taxed differently than capital gains, which is going to be taxed differently than interest income. So capital gains, as many of you are aware, you don't pay tax on the full capital gain. So right now, you're going to only pay tax on 50% of your capital gain inside your corporation, or if you have unregistered personal investments, again, you would only pay tax on half of the gain. But it's going to be at either your marginal personal tax rate if it's a personal unregistered investment, or at the general rate minus the abatements if it's inside your corporation. But you are only paying tax on about half of that. Now, if you take a flip side of that and look at one of the registered retirement tools like the RRSP, the Registered Retirement Savings Plan, effectively you're going to pay tax on the full capital gain on an RRSP. And we'll talk a little bit more about that when we do get to the RRSP section. But on capital gains inside your corporation, you'll pay tax on about half. On dividends, there is a special tax that is dependent on the type of dividend you receive. So there's something called an eligible dividend and another type of dividend called the non-eligible dividend. And eligible dividends are for publicly traded companies that have paid tax at the general rate, whereas non-eligible is for corporations that have received a small business deduction and have paid a lower tax rate. And because the corporation has paid a lower tax rate, you get a lower tax credit when you issue dividends to yourself. Now, that tax that you're going to pay on your dividend income, whether it's non-eligible or eligible, is actually a refundable tax. So the corporation will pay tax when it receives the dividends, but when it issues a dividend out to its shareholders, it will receive a dividend tax credit to offset those taxes that it paid in the past and effectively get back all the taxes. So it's just a flow-through tool. So the corporation will, if you distribute all the dividends you receive, not pay any tax on those dividends, and it will flow through to the individual at their marginal tax rate. And the beautiful thing about the corporation is that you've got some control over the years in which you take those dividends, so that you can take those dividends in years when you have lower income, i.e. retirement years. So typically what an investment strategy inside of a corporation looks like is during your income earning years, you're investing, generating, potentially interest income, dividend income, and capital gains. And then in retirement, you'll start to pull some of that money out in the form of a dividend. And hopefully that's in lower taxable income years. So it's done as not only tax deferral, but tax reduction by making sure that you're taking that into income in years when you're in lower tax brackets. So you've got, your capital gains where you're going to be taxed at half, your dividend income, which will flow through, and you might pay a temporary tax, but it will be refundable. And then you've got interest income. Interest income, unfortunately, you're going to pay tax on the full interest income at that general rate minus the abatement. So from a corporation standpoint, it's probably one of the least favorable forms of investment income. And this is the important thing that I want all of you to take as a takeaway from this session, is understanding that a good strategy is going to use all of the tools available to you, and you're going to pick and choose which investment products go inside of which vehicles. So things where you're banking on capital gains, probably inside of a corporation. Dividends, probably inside of a corporation. Whereas an RRSP, great for interest income because you'd be passed on the full amount, whether that's in an RRSP or inside your corporation. So inside of an RRSP can be an effective strategy for that. So that's sort of your first question is where do I put it? Do I put it inside of a corporation or inside of one of these tools that we're going to talk about today? And another factor to consider, not just, what type of income am I going to generate, whether that's interest, dividend, or capital gain, is the concept of compound interest. So compound interest is the growth on the growth. So if you have an investment that's generating a 10% return, in the second year, you're going to get interest, the 10% interest, not only on your original investment, but also on the return from the previous year. So that creates this growth curve, which is like a hockey stick, and is one of the key things to financial freedom, is investing early so you can leverage that compound interest. And the compound interest is an important thing to know and understand as far as which vehicles that you use and invest in, because an RRSP is going to give you some added benefits for compound interest, because effectively you're going to contribute to your RRSP and get a tax deduction personally, which effectively allows you to invest 100% of that investment. Whereas a tax-free savings account, you're going to have to come out. It's going to pay tax at your personal tax rate, which could be as high as 54%. So now you only have 46 cents to invest. Whereas inside of a corporation, you're going to pay tax at 12.2%, and then you'll have 88 cents left to invest. So RRSP 100% inside your corporation, 88 cents on the dollar, an unregistered investment or a tax-free savings account, 46 cents on the dollar, maybe a little bit more depending upon your marginal tax rate. But those are the critical factors for determining which vehicle you're going to use. Is what type of investment income is it going to be? And what is my compound interest growth rate going to be at based off of how much tax I'm going to have to pay to get it into that vehicle? Because as we talk about with the TFSAs, they're amazing tools, but depending upon your tax situation and your tax bracket, may not be the right tool for you right now. So again, we're going to talk about the pros and cons of each of these tools as we go through them. And again, understanding the general rates, the passive income rate, and the active business income rate inside the corporation. And then, of course, the deductions that you're going to get when you invest in the different registered vehicles. So inside your corporation, you have a couple of tools that you have available to you. You could just invest in typical stocks and bonds like you would outside the corporation. You can invest in life insurance policies. You can invest in EPPs, employer pension plans. You can set up separate holding companies, which does make sense once you've got about $200,000 worth of retained earnings. So there's a whole bunch of strategies that are available to your corporations, and they can get quite complicated and sophisticated. And it does look like we've got some questions coming through already. So let me see if I can get back to those. I think we've got questions. Q&A, yes. Is dividend the same as a director's advance? Great question. No, it is not. So a director's advance, and director's advances can be a little bit confusing, and they are something that are specific to owner-managed businesses. You won't see these in large corporations. But inside of a small corporation, often the strategy is that you, instead of taking a monthly set salary, will take money out of the corporation in the form of a loan, often called a director's advance. And at the end of the year, we will determine your salary or dividend based on the actual amount of money that you took out, so that we're keeping your income as low as possible. And we're, not setting an income that's too high or too low. We're giving you an income that is directly tied to the actual money that you're taking out of your corporation, so that we can keep that personal income as low as possible, which again, with the marginal tax system, the lower your income, the lower the total overall tax, right? And so the director's advance is going to guide what we declare as either salary or dividend, but it could be either. Now, a salary is a T4 type of income. It's employment income. It's subject to CPP. It's subject to employment tax. It's subject to potentially EI if you're not arm's length employee, or if you are an arm's length employee. Whereas a dividend is something for shareholders, not for employees. And it's going to get that dividend tax credit. It's also going to be subject to a dividend gross up. And it's not eligible for CPP, and it's not eligible. It doesn't increase your RRSP room. So typically what we recommend for our clients is that during your income earning years, you would take your remuneration in the form of a salary. And only once you retire and you're no longer pulling in income into your corporation would you switch over to a dividend strategy. Now, of course, you should discuss this with your account manager and your individual situation, because there are times when taking a dividend during your income earning years can make sense. But I'm going to take those exceptions and table them, hide them under the table for now. So hopefully that answers your question about director's advance versus dividend. And again, if you have questions as we're going, please feel free to ask them. I'm happy to go through them. Now, when we talk about personal investment strategies, you've got things like your RRSP, which many of you are familiar with, RESP, which is Registered Education Savings Plans, which I'm a big fan of. RDSPs, registered disability savings plans. Again, if you're eligible, great tools. FHSAs are first time home savings accounts, which is relatively new. It's the newest tool available to us. But again, amazing if you are a first time home buyer. And then you've got the TFSA, the tax free savings account. And we're going to run through each of those so that you can understand what the pros and cons of all of them are. As I said, an effective strategy is going to leverage all of these, but depending upon your age, different tools will become more applicable. If you're younger and haven't bought a home yet, your first time home savings account is really important. If you're a little bit older and you have some children, RESPs are going to be really important. If you have disabilities or if you have a child with disabilities, the RDSPs are going to be great tools. And the RRSPs and the TFSAs are going to be effective tools as well, used in different strategies in different times within, your lifespan. So let's talk through each of these by starting with the RESP. And I'm going to start with the RESP because if you have children, to me, this is something that you should be doing. It's the very first and, in my opinion, the most important investment vehicle. I'm a bit biased. I believe education is critical. It's also getting more and more expensive every year. I have my daughter going off to university for the first time next year, and we leveraged RESPs, so we feel quite comfortable and prepared for that, even with the rising cost of tuition and rent and all the fun things that go along with sending your kid off to university for the first time. But the reason that I like the RESP is because of the CESG, which is the Canadian Education Savings Grant. And a grant means that you're getting money for free. And that money for free is based on how much that you contribute to your RESP. And you can get up to $500 each year that you contribute $2,500 into the RESP for your children. Now, I'm trying to see, do I have the maximum here? Because that's indexed, and I'm not sure if I have that in my slide deck. I hope I do. I don't see it on my bullet points. Give me 1 second. Kasim, if you're there, can you pull up? We should have the what is the maximum amount of the CESG grant that you can get? I believe it's $7,200 if I'm not mistaken. You can also contribute if you've missed a year. You can contribute up to $5,000 in 1 year to make up for the previous year. But if you contribute $7,500, you're not going to get 3 years. You got to do it in those sort of 2-year cycles. In addition, the contributions that you make when you take them out, they're not going to be taxable because obviously they've been taxed already to get them into the RESP. But any of the growth will be taxable, but it's going to be taxable to your children, which is typically going to be at a time where they're in school and have education and tuition credit. So it's a very tax effective vehicle. The only real downside is that in order to contribute to the RESP, you have to have money that has been taxed already. Yeah, and so Kasim confirmed with me the maximum CESG is $7,200. So I wasn't sure if that had changed since last year, but it does appear to be the same. So at $500 a year, you're looking at 14 and a half years of potential contributions. So you want to get started on that as early as you possibly can. And it's one of the ones that I see is often overlooked. And so I do encourage you to start that as soon as you are financially capable of contributing to the RESP, because free money is free money. And once your children are born, you can actually start contributing right away. Most people don't, and obviously, because you can only contribute up until they're 18. And since there's only 14 and a half years to get the maximum CESG, if you miss a year or two, it's not necessarily the end of the world. but you don't want to miss too many years and not get the maximum grant. Um, so what else do we have here? Let's move on to um, oh, sorry, and it is in the slide deck. I just didn't go down far enough here. The CEST maximum is 7,200 and it is in my slide deck. So let's talk about RDSPs as well. So RDSP works very similar to an RESP. It's going to be eligible for a grant. The RDSP, or Registered Disability Savings Plan, is only eligible for people with disabilities. But what I have discovered is that there are far more disabilities that are eligible for the disability um, program than you might be aware of. And what I would encourage you to do is speak with your doctor, because in order to be qualified, this is not something that we as your accountants can do for you. It's something your doctor would have to apply for you to get qualified. But if you do qualify, the RDSP is great because it works the same way as an RESP. You get grants, and the grant is actually up to $3,000 per year, up to a maximum of $70,000, not $7,000, $70,000. So it's a much larger grant that is available. In addition, if you are eligible, you're going to get the disability tax credit on your personal tax return as well. So I always recommend, if you have anything like Crohn's or colitis or anything like that, or even ADHD, you might want to go and speak with your doctor to see if you would qualify for the disability tax credit and the registered disability savings plan, because these are quite beneficial. And the difference here is that the contributions can be made until the end of the year in which the beneficiary turns 59. Again, when you start pulling the money out, um, your original contributions are tax-free because you've paid tax on them in order to get them into the contributions, but the growth will be taxable based on the beneficiary's marginal tax rate. So those are the things to consider about the RDSP. But again, if you are eligible, probably a really important tool to leverage. Next, we're going to move on to the FHSA, the First Time Home Savings Account. This is the newest product that is available for you. Right now, there's an annual contribution limit of $8,000 and a lifetime contribution of $40,000, but it's so new that you're not even actually eligible to contribute up to $40,000 yet, based on the number of years it's been around. The beautiful thing about the FHSA is it's kind of like this hybrid between a TFSA and an RRSP, and gives you the benefits of both. First, anything that you contribute to your FHSA is going to result in a tax deduction personally equal to that contribution. So if you are a business owner and you take out $10,000 or $8,000 to put into your first time home savings account, that's going to, you're going to have to now pay personal tax because you're taking that into income, $8,000, but you're going to get a tax credit on your personal tax return. So it's effectively like there's no change in your income, and allows you to get that money out and invest it, as we said, at 100%, because there's no tax implications of investing that into your FHSA. And if you take the money out for the purchase of a home, it's not even taxable then. Whereas on RSP, if you take the money out, it becomes taxable when you withdraw the money. So the FHSA gives you the benefit of it, not of it being completely tax-free all the way through, provided you use it for the purchase of a home. So it's a really, really effective tool, but with a lifetime limit of only $40,000, as you can imagine, that's obviously nowhere near sufficient for the cost of a home in Canada these days. And you want to be looking at other tools, like using your RRSPs and the first-time home buyers and the home buyers plan, in addition to the first-time home savings account. Those two tools should be leveraged if you're buying a property. But this can be a very, very effective tool for people who aren't property owners yet, and does go a long way to helping making home ownership a little bit more approachable in these times where I know it can seem daunting to be able to purchase a home in downtown Toronto these days. So it can be a very, very effective tool. So we've covered the FHSAs. Now RSPs, I'm sort of leaving these towards the end because these are my least favorite tools for um, owner managers, for people who are self-employed. And by the way, Joe, you are asked if I'm sharing a slide deck. I'm not sharing a slide deck. We're kind of doing that intentionally. It makes for better video clips that we use on various social medias afterwards. So we're not sharing a slide deck. If you'd like a copy, we do have a slide deck. We can make that available to you. And I'll actually ask my colleague to share that with all the registered attendees afterwards as well. But the RRSP, I'm not a big fan of because first and foremost, our strategy when you're an owner manager is to keep your income as low as possible. So you're not going to have a huge amount of RSP room the way you would have if you're a full-time employee. You're usually not getting the max contribution each year because we're trying to keep your personal income as low as possible and leveraging other tools within the corporation. In addition, the biggest problem I have with RSPs is they're often used improperly. When they're used properly, they can be very, very effective tools for a form of tax deferral and potential tax savings. But all too often, I see them used improperly, and they end up increasing your taxes rather than decreasing your taxes. And what I mean by that is, unfortunately, many people pass away with large amounts of money inside their RSP. And when that happens, it's going to be taxable to your estate at your marginal tax rate. And typically that's at the highest marginal tax rate because you've got a lot of money sitting in your RSPs and now you're into the highest tax bracket in that terminal year. And that can be made even worse if you contributed at low tax bracket years. Like worst case scenario, you contribute at the lowest tax bracket and then you take the money out in retirement at the highest tax bracket. So you've actually increased the amount of taxes rather than decreased them. You've got some deferral, from your income earning years until your retirement years, or to your terminal year, but you haven't got tax savings. The ideal strategy is you're contributing only at the highest marginal tax brackets, which for many self-employed people, you'll never be at the highest marginal tax brackets because our strategy is to keep you with much lower tax strategies, much lower tax brackets. But the ideal is you've contributed at a high tax bracket, you've invested, you've earned interest income, which would have been taxed at 100% inside your corporation anyways, and then you take the money out in retirement in lower tax brackets. And what I strongly recommend anyone to do is consider an early wind up of your RSP and looking at that as one of the first vehicles that you start taking money out. Not taking money out of your corporation first, but taking money out of your RSP first, because a corporation, you're going to have opportunities like pipeline maneuvers and other tools that can continue to defer the tax beyond that terminal year end. There's just more options available to us. And other things like insurance products, which are amazing from a terminal standpoint, because, in that situation where you've passed away, any benefits that you receive from an insurance product are completely tax-free. So much better tools inside your corporation that are available for you rather than an RSP. So you want to be like the RSPs can be a tax deferral. Like if you're, very young person, you want to be contributing, getting advantage of that tax deferral, and hopefully even a tax savings by, contributing a higher income earning year and pulling it out at a lower income year in retirement. But you want to start tapping into that far earlier than the obligated RIF years of 71. So once you're hit 71, you are obligated to start pulling money out of your RSPs, at about 5% per year. But my recommendation on RSPs is that you start pulling into that much earlier than you're obligated to. And that ties into another thing that I don't have in my slide deck, but I did want to have a conversation about, which is maximizing the CPP benefits. And as I said earlier, we do recommend using salary during your income earning years because it's going to get you CPP and it's going to get you RSP room. And CPP is a very effective tool when used effectively. But again, it's a tool that's often not used very effectively because people just use it as the default sort of um, way that you just once you hit 65, you start collecting and you don't defer. And in fact, it is usually better. I'm just trying to pull up some information about the CPPs because I did get some information that I pulled up. Because if you do take it early, I believe it reduces it by about 36%. Here, I'm gonna get it back up here again. There we are. Okay. CPP. So yes, if you take it at 60, you're only going to get 64% of whatever your benefit is. Now, again, CPP is exceptionally confusing because the amount of CPP benefit that you will receive is a function of what you have contributed to CPP. CPP is Canada Pension Plan for those who are not familiar with it. But you're going to get in retirement a function of what you have contributed. And the good news is you can go to Service Canada and you can find out exactly how much you've contributed and what your projected benefit is going to be. But it's an often underutilized tool that, with people living longer and longer, can be a very effective tool. Now, unfortunately, it's nowhere near enough for you to live off of in Canada. But you could, at the very least, if that's all you had, you could go live in Southeast Asia or something off of, what you're going to earn off that. Because, for the average person, you're probably going to get about, $1,000 to $1,500 a month from CPP. But if you take it at 60, you're only going to get 64% of your benefit. If you take it at 65, you will get 100% of your benefit. But if you take it at 70, you're going to get 142% of your benefit. So no one has a crystal ball to know exactly how long you're going to live. But I think that they say if you live longer than as short as 78, you will get a better benefit by deferring until you were 70. And there's been a whole bunch of people who've done a whole bunch of actuarial calculations. And it's like, I think it's 82 if you don't have any money in your RRSPs, but it's closer to 78 if you have money in your RRSPs because, again, a CPP income is taxable income. And you got to factor in OAS clawbacks. You got to factor in marginal tax rates to figure out what the true benefit is going to be. But that break even is somewhere between 78 to 82. And in almost all situations, it's going to be beneficial to defer your CPP until you were 70. And again, that ties back into how much or what investment vehicles you have and how much income that you're going to have in retirement. And again, if you're deferring your CPP between 65 to 70, that's the time that you should be pulling money out of your RSPs is between 65 and 70 is start pulling that out earlier than you have to, maybe even as early as 60, depending upon, your financial, prospects and how you've done as far as, you know, saving and compound interest and all the amazing things that go along with investing for financial freedom. So trying to figure out where I left place here. So RSPs, the RSPs will reduce your taxable income. They're not taxed until you're withdrawn. The other thing to note, the other difference between an RSP and a TFSA is a TFSA, it's a great emergency reserve fund because if you need to, redo the roof on your house, pull all the money out of your TFSA, well, if you wait a year, you'll get that room back and you can contribute whatever you had to take out plus your additional growth for that year. Whereas an RSP, if you had to take the money out of your RSP, you're going to be taxed, number one, which is not great. And number two, you're not going to get that room back. So you never get that room back to contribute back into your RSPs. So that's important to know. TFSAs, we haven't really covered yet. So tax-free savings account are a relatively new tool. Right now, that the cumulative lifetime limit is up to $102,000. So if you've never contributed, you can contribute up to $102,000. The 2025 year rate was $7,000. That's how much you can contribute in $7,000 if you'd maximized up to the years before that. Now, unfortunately, you're not going to get a reduction in taxable income for any contributions to a tax-free savings account. However, the beautiful thing about a tax-free savings account is that the growth is tax-free. So the contribution isn't tax-free. You have to pay taxes on, you have to have paid tax on whatever you're contributing into the tax-free savings account, but any growth is tax-free. So again, getting money into the TFSA as early as possible, provided your marginal tax rate gives you the room to contribute to that without having to pay tax at 54%. So if you're a middle or lower tax bracket, you do want to leverage this and get money in as early as possible so you can get that compound growth and get as much of that tax-free savings as you possibly can. And it's been around since 2009, so it's not that new anymore, but it's the second newest thing to the first-time home savings account. And is a very, very effective tool for an emergency reserve fund. And I do recommend people do that. And one of the things you might even consider if you were, we have clients who are older who haven't maximized the benefit of the tax-free savings account. And if you're, 60 plus, what you might consider doing is taking money out of your RRSPs. Yes, you're going to have to pay some tax on it, and moving it into your tax-free savings account if you've got the room. Because you're moving that from, growth that would be taxed, because when you take it out of your RRSP, you're going to be taxed on whatever it is. And that means 100% of the growth is taxable in an RRSP, into your TFSA, where the growth won't be taxable. And if you do that strategically over a period of time, you can avoid, what the RRSPs being taxed at the highest tax rate on death, and moving it into a TFSA, which won't be taxable to the estate. So good strategies and tools to use and think about when it comes to that. And then lastly is non-registered investment accounts. These don't reduce your taxable income. They're subject to your personal marginal tax rate. The only reason you might consider an unregistered investment account is if you maybe inherited a bunch of money, you've already maxed out all the other tools that you've got available to you. So you might want to consider this, or you're a high income earning employee, and again, you've maximized all those other things. The one benefit to a non-registered investment account, well, actually, I guess there's kind of two. One is you can use leverage on an unregistered investment account. You can't typically use leverage on registered accounts like TFSAs and RRSPs, which means you can borrow against the investments that you have to be able to invest more. Not personally a big fan of leverage. I've seen it cause more problems than benefits it's created. But the other thing you can do with an unregistered investment account is something called a Smith maneuver. And a Smith maneuver allows you to borrow money, again, leverage, put it into investments, and then the cost of borrowing, the interest, is deductible against the investment income that you have in those unregistered investments personally. So that is one tool that might make sense in those situations. So again, if you've got a lot of cash and you've already maximized RSPs and TFSAs and your corporation, and you're looking at non-registered, time to have a conversation with your accountant and look at things like the Smith maneuver as a tool that might be applicable to you. Got some more questions coming through here. I'm going to try and tackle those. Noted that capital gain inside a corporation is 50%, and you mentioned something like 26 or 28%. What is the tax rate on the 50% capital gain? So it's going to be, the effective rate is going to be closer to about 28%. The general rate, as I said, is 38%, but then there's an abatement, which gets really complicated. But for most people, your typical effective rate is going to be closer to around that 28% on those capital gains, as well as the interest income and capital gains, both going to be at around that 28%. Is there such thing as a TFSA inside the business? No, there is not. Um, there is um, there are vehicles like IPPs, individual pension plans, that could kind of operate somewhat similarly, but not even really. Like they're just completely different tools and vehicles, so they're not really an equivalent. Um, we have mutual funds inside of a whole company. They cause the issuance of both T5s and T3s, so dividends and interest income. Why we don't know. Are there any other investment vehicles inside holdcos that are more beneficial tax wise? I mean, so a holding company can invest in just about anything. You can invest in real estate, you can invest in stocks, in bonds, in mutual funds, um, just about in other companies, just about anything. So there's a ton of them. Um, where do you get the most tax efficient? This gets a little bit complicated, and it depends largely on your corporation. And what I would say is the biggest um, opportunity that I see people not aware of is that a few years ago, the lovely liberals introduced a new tax rule that says if you have more than $50,000 of passive income, it will begin to erode your small business deduction limit at $5 for each dollar over $50,000. So the small business deduction limit is $500,000. That tells you that if you had $150,000 of passive income, you'd have $100,000 over the 50,000 exemption. So 100,000 times 5 is $500,000. You would be left with no small business deduction limit. This is often an issue that I see happen because people will sit on their unrealized gains and then realize them all, one lump sum, pushing them over that exemption limit in that 1 year. So the biggest and most important thing I see is opportunity wise with corporate investing is working with a financial planner, which I think is, and we're not financial planners. I strongly recommend you work with a financial planner. If you've got more than $100,000 of investments, you should be working with a financial planner. So working with a financial planner who's going to be actively reviewing your documents, just like we have a year-end review, you should be having a year-end review with your financial planner to look at, hey, should we do any tax loss selling? Should we be realizing any gains? Should we be mixing up our portfolio mix? And whether that's a mix, based on diversification between, tech stocks versus bank stocks versus REITs versus what have you, or diversification from the standpoint of the types of income, whether that be dividend income, um, uh, capital gains, or interest. Now, I'm not a financial advisor, but what I will tell you is I am biased towards dividend income. I love dividend income because it's cash flow, which I like. So it's bird in the hand is worth two in the bush, so to speak. Um, Plus, it can be tax efficient because it's going to flow through to the shareholder. You may pay some tax in the interim inside your corporation, but that's a refundable tax, as I mentioned earlier. You'll get back 100% of that tax inside the corporation. So the corporation is just a holding place for those dividends, and it will flow through to you getting the benefit. And the benefit from the shareholders' standpoint is that it is not going to pay tax at the full tax rate because it's going to get credit for the taxes that the corporation has already paid. So if your corporation's paid 38% and your marginal tax rate is 38%, you're not going to pay any more personal tax. If your marginal tax rate is 54%, yeah, you're going to pay the delta between that 38 and the 54. And the way they calculate that is quite complicated. They do a dividend gross up and a dividend tax credit. And they tweak that every few years um, to correct for problems in their formula. But its whole principle is designed so that you will get credit for the taxes that have already been paid, so there's no double taxation. Occasionally, you might see a dollar or two difference in benefit, but it's designed so that there really isn't a benefit of taking a salary versus a dividend if you as a business owner have that control over it. So what I would say is I'm biased towards dividend income inside the corporation. Um, but again, it depends on your individual situation and your goals and how much money that you are actually saving. Because if you need this nest egg for yourself in retirement, that is a completely different strategy than you've already set aside enough for yourself. And now you're talking about a legacy for your children or an important cause. And whether it's for your children or for a charity, again, those are going to be completely different goals and structures. If you're getting into, if it's for your children, life insurance is definitely going to be the best tool. If it's an important cause, then, charitable contributions and the way you do that, the way you structure that can be done very effectively. Like maybe you might actually even donate stocks. And it gets quite complicated when we get into that. And there are benefits to doing that because, if you're sitting on losses or gains, there's different advantages to donating those stocks instead of taking the gain or the loss and then donating the cash flow. So I hope that answers your question. I love these questions. I love seeing this. This is a great opportunity for you to come in and get some free input and free advice. We've covered the meat of what I wanted to cover today. I'll leave the Q&A open for a few more minutes. But I want to remind everyone that we are here to help. If you're not familiar with us and our organization, we do offer free initial consultations. We do have a turnkey solution where we offer in-house paralegal services. So we can do everything from starting up your corporation, the bookkeeping, the ongoing accounting, to closing down your corporation, and everything in between. A couple of things that make us unique is our benchmarking analysis, which we do for each and every one of our clients, our audit representation protection, and our unique industry knowledge. As you can tell, a lot of the things that I'm talking about are very specific to owner managers and service-based businesses. We have specialized in this niche since 1984, as I said earlier, and we've learned the tips and tricks that are specific to your industry and can help you. So I've noticed that you have many customers, 30 plus years old. Could we have a separate session on winding down, or is that a one-off? No, I think we could do a separate session on winding down your corporation and strategies available to that because the reality is, we have lots of younger clients as well, but Canada is aging. It definitely is. We've got lots of boomers, Gen Xers, and also clients who've just done well and want to look at retirement strategies. So that is definitely something I will make sure to work with Kasim, who's covering for his sister right now and monitoring this call, to include that as a potential webinar. Unfortunately, the one downside is we plan out all of our webinars for the entire year in like November, December. So we plan them all out for the rest of this year. So it may not happen this year, but I will definitely get it included at least next year. And if we can find a way, if we've got an opening in a slot, we'll see if we can work that in because I can see that being a useful session. And again, thank you everyone for joining us and coming out to the session today. If you want to check out our upcoming webinars for next in 2 weeks, which is going to be, you told me right before the session what it was, and you'd think I'd remember, but of course I don't. What's the topic section again? Anyways, go check it out on our website. And again, thank you for taking time out of your busy schedule. And if you're new to us, please check out our website, CPA4IT. We've got a ton of content. Follow us on all the social media channels and stay with us. And thank you. Audit readiness. That's what next week. Thank you, Kasim. Next week's session is on how to be prepared for an audit and how to protect yourself from audit risk. So this is going to be a great session. So thank you, everyone. Have a great day and bye for now.